To continue Chapter 1, this next section is Introduction to Financial Statements and the learning objectives. Describe the content and purpose of the income statement, statement of retained earnings, and the balance sheet, and be able to prepare an income statement, statement of retained earnings, and the balance sheet. So the questions related to this section of Chapter 1 will be mainly preparation of the financial statements. To begin with, we start with the income statement. Now, the income statement is what's called a time period statement. That is, this statement, Sierra Corporation, is going to cover the month of October. The transactions now are a summary of all the revenue and expenses incurred during the month of October 2012. That is from the beginning October 1st to the end of October 31st. Revenue. This is a summary of all transactions where we perform services for our customers. That is what revenue is. Every time we perform the service, we earn revenue. Now, the expenses are costs that we incurred in order to earn that revenue. Now, these expenses are listed in any order. It doesn't matter. They're listing them highest to lowest here. But we incurred salaries expense. We paid the employees. We had supplies expense. We had some office supplies or other cleaning fluids or what have you, depending on the type of business we are. We had to pay rent. We had to pay for insurance. We also had some money that we borrowed from the bank, so we had to pay interest expense. And then we had what's called depreciation expense. We'll talk about depreciation much later. But basically, when we use up an asset, we call that depreciation. So we total the expenses. And notice we total them, if you can visualize here, two columns. This is the outside column and the inside column. Now, when we're summarizing a lot of data, we move to the inside column, draw the line, and carry it to the outside. So out here we have the two things, revenues and expenses. Revenues of $10,600 and expenses of $7,740. And net income is the excess of revenue over expenses. Now, this net income belongs to the shareholders. And so the next statement is a statement of retained earnings. So the statement of retained earnings is the same time period. The month ended October 31st. Now, at the beginning of the month, we just started business, so we had no earnings. It was zero. We now add the net income that we just had from the income statement, $2,860. So now the shareholders have $2,860 in retained earnings in this corporation. But during the month, the corporation paid back to the shareholders $500 in the form of dividends. Now recall the different terminologies from the previous video. And the dividends belong to the shareholders. They're paid out in cash. So what remains is $2,360. And that belongs to the shareholders, which will be recorded on the balance sheet as well. Now, the balance sheet. The balance sheet is at one point in time, October 31st. So if we're talking about the income statement, you see the income statement was for a month. It's a time period. It can be for a year, it can be for a month, it could be 6 months. But it covers a time period and reports the transactions during that time period. So the income statement, think of it as a moving picture. Whereas the balance sheet is a snapshot, a photograph of exactly the assets, liability, and shareholders' equity at the end of business, October 31st, 2012. And remember the balance sheet equation. Assets equal liabilities plus shareholders' equity. Well, the assets are listed here. Cash, accounts receivable, supplies, that's what we use there. Prepaid insurance, if I pay the insurance in advance, that's an asset called prepaid insurance. And equipment, net of depreciation. And we add them all up here, and we have total assets 21,910. Now these are resources that are owned by the Sierra Corporation. The Sierra Corporation uses up these assets in order to earn its net income or its revenue. Now, who owns these assets? Well, you see, we either owe people outside the business, which we call liabilities, and we, the shareholders, own the balance. So we list the liabilities. Notes payable. We'll explain what notes are later. It's a formal financial document. Accounts payable, remember that term. We have suppliers, and we have an account with those suppliers, so we have owing them $2,500. Salaries payable, we owe our employees. Unearned service revenue, now that's a weird little thing we'll talk about later. That happens when a customer gives us money in anticipation of us doing the service in the future. Interest payable, what we owe the bank. Notice we add them up on the inside here, total to the outside. So there's your liabilities, $9,550. Now the shareholders' equity section in two parts. One, common stock. That represents the amount of investment the shareholders put into the company. They invested $10,000. And two, retained earnings. Now keep in mind, this came from the statement of retained earnings, $2,360. So those two together say that, okay, the shareholders own $2,360 of the assets of the 21,910. Or another way to look at it, assets equal liabilities plus shareholders' equity. But this is why it's called a balance sheet. We balance. And this is a listing of all the accounts. This tells us the position of a company as at the end of October 31st, 2012. Now the balance sheet we presented in the previous section, just for purposes of showing you how it relates to the income statement and the retained earnings statement. But in reality, what a corporation presents is what's called a classified balance sheet. Okay, classified means we classify the assets into short-term and long-term, and we classify the liabilities into short-term and long-term. So there's a particular way in which we present the data on the balance sheet. To begin with, we take the section of assets, and we take what's called current assets. These are assets that we're going to use up shortly after this date, October 31st, between October 31st and the end of the year. All right. Now we list them in order of liquidity. Liquidity is a term which means cash or near cash. The most liquid asset is cash. And so we have cash, $6,600. We may have some investments in the stocks or bonds. They're called short-term investments, so they can be turned into cash very quickly. Now accounts receivable, recall, that is what's owing to us because we provided a service or a product to a customer and they're paying us later, so that too will be cash very soon. Notes receivable, that's a formal financial document. Inventory we will turn into cash and then collect supplies and prepaid insurance. We list them in that order. And we say, okay, the total current assets, $22,100. Now, separate from that are what are called long-term assets. Now, they're categorized as long-term investments. If I own stock in another company or if I invested in some real estate, okay, I show that separately. Then I have a whole section called property, plant, and equipment, which are also called fixed assets. Now these assets are tangible assets. They're land, building, equipment, trucks, and things of that nature. And so land is one, but equipment we depreciate. So we bought the equipment for $24,000, but we've used up $5,000 of it. So the undepreciated portion of equipment is $19,000. These two together total property, plant, and equipment. Then we have intangible assets like a patent or a trademark. The Nike trademark, for example, which is a check mark. They are worth money too, but they don't have any physical substance. They're called intangible assets, so we list them separately. So this is the more complicated part of a classified balance sheet, is the assets. Because here the assets are $61,400, but they're broken down into those assets, $22,100, that we're going to use up very quickly after this balance sheet date. Long-term investments, which are going to stay there for a long time. Property, plant, and equipment, which we're going to use over the next 5 years. And patents, which also has a long life. Now, by the same token, we classify the liabilities into short-term and long-term. And the current liabilities, notes payable, I owe money to some other business and I have given them a note. Accounts payable, that's what I owe my suppliers. Salary and wages payable, unearned sales revenue, and interest payable are all current. They're going to have to be paid within the next year, basically. And these are liabilities that will be paid in longer periods of time, more than a year. Mortgage payable, a mortgage is is the money I borrowed from the bank to purchase property or a building. And notes payable. So we have total long-term liabilities. We have current $16,05, long-term. Total liabilities $27,350. Now, as far as classification, shareholders' equity, it's just common stock and retained earnings. And notice again, total assets equal total liabilities plus total equity. So the total assets $61,400, liabilities plus shareholders' equity $61,400. So that's an introduction to financial statements: the income statement, the retained earnings statement, and the classified balance sheet.